right, first up on the show, Mumbai-headquartered asset manager Piper Serica is going to launch a larger close-ended vehicle than what was initially expected, and they're going to double the capital raised for an angel fund. Let's understand a little bit more about their game plan. We've got Abhay Agarwal. He's the founder and the fund manager with us right now. Thank you so much for taking time out. So initially in the month of January, it was 250 crores that was planned for the AIF. Now it's about 500 crore rupees with a 250 crore rupee green shoe option. Tell us a little bit more about the latest AIF.
Yeah, so this is a Category 2 AIF that we plan to launch soon. And what we have right now is a Category 1 AIF, which is soon going to be a 350 crore fund. So what we wanted to do was to instead of taking more money in the Category 1 AIF because it has certain restrictions, to do a Category 2 AIF so that we can do a lot of follow-on investments in our existing portfolio company through the Category 2 AIF. So the plan is to structure it as what is traditionally called a winners fund, where you take some of the companies in your existing portfolio that are doing very well and support them in their next fundraise, either as an anchor investor or as a participant in their round. And since we already have a captive base of 40 odd companies that we have invested in, it just makes sense for us to do the Cat 2 AIF. And I think we are already seeing some very good interest from investors in participating in this round, in this fund.
So who exactly will you be targeting in order to raise this corpus?
So I think we are expecting about half of it to come from our existing Category 1 AIF investors. That includes HNIs, ultra HNIs, family offices, small family offices. In the Cat 1 AIF, we did not really raise money from international investors. So we would like to talk to them, showcase them our performance so far. So I think half of it will come from our existing investors, and the remaining we expect to get it from allocators who allocate to private equity funds from India and across the globe, which includes some large family offices, plus also institutional investors like Sidbi Ventures and some of the other fund of funds.
And what is the average check size that you're looking to put out? What kind of startups, what kind of companies is it that you're zeroing in on?
So if you look at our current strategy, it will be an extension of that. So we have been investing in technology-oriented companies so far. Basically, sector agnostic. So we don't really think too deeply about the sector that they are focusing on, but we want to back companies that are develop new technologies to bring efficiencies to their existing customers. Their customers could be B2B or B2C. So we have invested in companies that are into electric vehicle space. We have invested in companies that are in genome sequencing, healthcare tech, insurance tech. We recently invested in a company in debt resolution, escrow banking. So multiple use cases across the board. But one common thread across all these companies is that they have very strong technology orientation. And they're very solid market fit already. Many of them are already close to break even. So we want to continue to do the same thing in this current fund, that is to back companies that are focusing on developing technology in India to cater to a global market. And we are seeing early signs of success there. So I think our focus will continue to be on the same space. We are not really looking at making D2C investments from this fund because that is something that I think we do not understand as well. So we would stay away from that space, but just focus on companies that are using technology in a very effective manner and a very capital efficient manner and bringing it to their customers and getting paid for it.
So how exactly do you see the importance of tech disruption growing? Because you have invested in a number of tech companies as well.
Yeah, so that's very interesting because we have a pretty strong public market investing arm. And if you look at Piper Serica, which is the fund, which is the company that I run, we have public market PMS and FPI account out of Mauritius. And then we have this early stage investing fund. So the advantage that we have is that we see, what is happening in the tech space from both the perspective of very large IT services companies, IT companies like TCS, Infosys, and also startups that are disrupting some of these companies. And I think that helps us assess a lot of them. And while it has become like a cliche thing in the media and analyst community to talk about AI and ML and the disruption coming from that, we are actually seeing it play out. We are investing in companies that are using AI ML to do projects that, say, a TCS or Infosys would charge $200 million for, to do it in 1/5 of that cost for the same customer in a much faster manner, more efficient manner, and at the same time giving more control to the customers. So I think some of the problems that the large IT services companies are facing globally, and that includes IBM, Accenture, Capgemini, are driven by the fact that they are not being as innovative and as disruptive as the more nimble startups have been. And I think that trend will continue to play out because once this funding winter is over and these young startups start getting more capital, I think you will see the pace of disruption increase even more. So I think, and this is going to happen across verticals, and this will not be limited to only the Indian market. So we are seeing it happen across healthcare, very essential. We are seeing it happen across financial services, more inclusion. I think some of the large banks, especially, we see them being on the back foot with their digital banking products, while some of these newer companies are launching the products in a very, very efficient manner, using technology to access, go to market at a cheaper manner, and also service their customers in a much cheaper manner. So I think disruption is something that the large companies are seriously under threat of, which is being driven by these startups.
So will you be using the proprietary AI/ML based tool Yoda.ai in order to screen investment opportunities for this round as well? Tell us more.
Yeah, so that's a tool that we develop, which kind of codes 30 years of investing experience. We built it as an AIML tool, as a predictive tool. So what that helps us do is to look at a lot of startups and filter them quickly. So we score startups on 17 variables in a very objective manner. And only when the score is more than 70% probability of success, we pursue them. So what this tool helps us is to maintain a very high rejection rate. So for instance, if you have invested in 40 companies, we have actually looked at 1,400, 1,500 companies with a 3% success rate or 97% rejection rate. And this tool looks at multiple variables. It looks at what is the founder background, age-wise, how many founders are there, what is their background, how intense is their connect with the ecosystem that they are part of, what are their core skills, is it a full team, that has tech skills, sales skills, product skills, and then it looks at what is the business that they are in, is it a competitive industry, are their product market fit already established, are there global proxies. Then it goes down to looking at what is the profile of the co-investors, who are investing. Do they have the capability of putting in more money? So like that, we are able to score companies very quickly on that and reject the ones that do not fit into our criteria. So this tool has worked very well for us in this current fund, which is a smaller fund. And we hope to tweak it a little bit. I think we will need to tweak it, backtest it again for the larger investments that we look to do from the category 2 AIF. But I think it's a phenomenal tool that has really helped us a lot in screening startups.
So what's the overall AUM? How much does it stand at? What is the outlook when it comes to your AUM growth?
Our current AUM in the private, so Piper Serica as a fund house, we manage about across all our products about 1,200 crores. Of which about 300 crores is the category 1 AIF, probably, and that's where we plan to stop it, 300 to 350 crore of AUM. And the target is to raise a 500 to 750 crore category 2 AIF that will invest in later stage startups that are going through larger fundraisers.
And what's the view then on the current scenario when it comes to startups, the kind of funding winter that we've been through, what the year ahead holds according to you?
I think it's a complete buyer's market right now, and uh, it is while as an investor one would expect to feel happy that this is a buyer's market and you can get great terms. At the same time, as an ecosystem participant, it also worries me that there are a very large number of investors, including some very large investors, who are sitting on a lot of dry powder, but are not allocating capital to very deserving startups. And we are seeing some of the very promising startups in India starting to struggle because I frankly think this is as bad as it can get. There are follow-on rounds are becoming difficult, even for very capital efficient startups. The going is very difficult. Uh, but if I look at it from an investor's hat, I would say that yes, we are getting very sensible terms now. We are not trying to bottom fish or push the founders back to the wall and say, give us the best terms or we will not invest. We are taking a very collaborative approach with the founders and saying that, look, what is a sensible term? We want to come in, do a bridge round if required, do a follow-on if required to help grow the business. So I think things are as bad on the funding front in the startup space in India as they can get. I expect them to improve over the next 12 months and the cycle will reverse. But for next 12 months, we are also telling our founders that they need to be very capital efficient, reduce the burn to as low as possible. Do not spend money on anything that is discretionary. And I think that trend is going to continue for 12 months. And that is why we are in a hurry also to not only raise this fund, but also deploy it quickly, because I have seen from my experience that markets which have very low participation from investors are actually the best markets to invest in. So we want to benefit from that opportunity that we see for next 12 months, work with very good co-investors, good founders, and deploy our capital. But this cycle will turn. That also I'm pretty sure of. Maybe a year out, you will have all the funds that are sitting on a lot of dry powder suddenly realizing that their funds are coming to an end. They need to return capital, and that's when I think everybody would want to jump in and start investing.
All right, thank you so much, Abhay, for joining us on Startup Central.
If you like this video, then like, share and subscribe to ET Now.